What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is April 20th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I not only want to spend some time to talk about the continued strength in cryptocurrency markets as Bitcoin has remained above 7,000 and altcoins have set a fourth consecutive week of higher market dominance gains, but along with that, I want to spend some time to talk about a broader topic when it comes to traditional markets and the traditional economy, and that is the excessive financialization of most Western markets such as the US, Europe, Canada, and Australia. And I want to go ahead and just dive into this a little bit as we go throughout the video. It'll make more sense as we talk about it right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. Bitpanda Pro is the secure European exchange for crypto to fiat markets. Bitpanda has been offering secure, straightforward, and easy access to the cryptocurrency market in Europe for over 5 years and wants to offer the same service to more experienced traders, users using trading bots, and other advanced clients like cryptocurrency businesses and institutional investors. With the steady addition of more and more crypto to fiat trading pairs, Bitpanda Pro has made itself a convenient, secure, and trustworthy exchange to onboard or cash out easily. Check out the link down below in the description to learn more. Alrighty, so let's go ahead and take a look through cryptocurrency markets from the start here. You can see the vast majority of cryptocurrencies right now are starting to teeter barely into the red here, down about 2 to 3% for most of the players here. Again, nothing too severe here. This is again coming after multiple days of gains. So we're still sitting above the $200 billion mark. Good milestone to get back above here. Really basically solidifying that we've basically made up for all of the gains, or excuse me, all of the losses that we had back from the crazy sell-off back in early March. So a month later now, we're back to where we were before, simply put. All right. Now, I want to go ahead here first to talk about the strength in altcoins, and we'll really dive into Bitcoin as we go throughout the video and what to watch for here in the short term. But right now, the chart's looking great, guys. Again, as we've talked about, we take a look at the logarithmic chart here, and we take a look at the line of resistance and support here that we've had drawn, again, back here for some time on the chart as we started to call a reversal on basically Bitcoin dominance, therefore meaning altcoin dominance going up back here in September. We took this position of a trend reversal, and so far we've been on the winning side so far, guys. I've increased a lot of my, if you want to just look at it very simply, I've increased my Bitcoin position in this case, or at least the amount of Bitcoin I could buy with my capital. And along with that as well, I've been in a lot of the players here that I actually just feel confident holding for some time as they're either building real value or they actually have a project that does something and has some kind of utility tied to the token. And in this case, what we've been doing is not only holding on this line of support here, right, as we started to set the significant high, right, we came in for a higher low here along this line of support, but also we set a significant low away from the line of support here. And the importance of this here is it's showcasing us that, again, the lows are starting to get further and further away from the line of support, meaning that bulls are coming in at higher prices. And what I think is very rational to see here is I don't think we're going to just go through this week or next week and break through and kick off a massive altcoin rally. I don't think the momentum's there just yet. I think we need to wait for the halving event. But what I do see happening, I'll go ahead and get the polyline tool here, is basically where we could tailor up to this line here over the next few weeks, bounce across here, get above, make it support, right? And after that, we could start to really leap forward sometime into late 2020 or into early 2021. Again, I'm not here to get too eager in it. And again, you can see that October is a decent ways away here, guys. I know it doesn't sound very exciting, but at the end of the day, I'm going to be waiting for this to really signal, in this case, that it's going off, right? Now, I've positioned myself, and the thing I emphasized in previous videos is, again, I don't really see much downside at this point being positioned in the altcoin positions. And man, they've not only been the market leaders here that are probably going to continue leading the way forward as they've built momentum over the last coming months. And usually it tends to be that the best performing charts still continue to be the best performing players as you go along. But along with that, again, there's not much really downside risk here, right? Possibly a few percentage points here down to the line of support before we really take off. But again, my time frame isn't what happens here or there. It's what happens over here, right? What's happening in what would basically be the time period for the next cycle, okay? So again, really love seeing this confidence here. Higher highs, higher lows. We want to see that continue through here. And I think if we get up to 37.9 or 38%, I think that's going to solidify here, setting that third higher low here, or excuse me, third higher high comparative to this high and this high. than that we're going to probably be getting the next cycle here in the next coming months. Now, to talk about Bitcoin's price pushing a little more sideways here over the last few weeks, or really actually through the past month of April here. Again, still generally up here for the month of April, a few $100. Now, the major thing that I want to talk about here as we are holding here at this price is what I'm looking for, right? Now, right now, you're in a very interesting point here in the sense of price. For those of you who want to learn how I would look at the market in more of a short-term perspective, I know many of you know that I'm waiting for the halving event. I think we're going to charge forward into the halving event, and that in many ways, right, we're going to have a correction afterwards. And in the long term, I've got a very long-term big price target of 100K in late 2022. What I want to talk about in the sense, if you want to analyze price in the short term, this is how you should generally look at it, okay? So you have to understand at the end of the day, markets are buyers and sellers, right? And the major thing to take a look at here for price is significant lows and significant highs. Now we can see here that these significant lows each and every time, right? Every time we have a pullback, even though it might be a stark pullback, we still had a higher low than the previous time, right? You can see that here. You can see for here, for example, we had a higher low than compared to back here. Along with that, as we rallied up to this new level here around 6,900, we came back down, set a higher low than previously. We rallied forward, and then we set down a low, and it was higher than the previous low. So you can see here that we're not only setting higher highs, but we're setting higher lows. Now, one thing that a lot of people will point to is right now, the other day, at least according to the price section we have for April 18th, right, we have set in a lower high than where we were back the other day, right? Peaked out around a little bit above 7,200, and over here is more around 7,400. Now, the question here is whether or not we're going to see prices kick up here over the next 24, 48 hours or so and get above to new relative highs above this previous high, or if it dips below the previous support level. Right now, we're in what I would say is a neutral trend right now, right? We had a very nice short-term kind of, not so much correction, basically a short-term rally here to make up for the losses back from March. And we haven't fully made up all of those losses just yet. We've made up the majority of them here. But all in all, right, the major thing here is to see whether or not we break those lows or we break the previous highs here. At least the relative highs. I know this isn't the all-time highs for Bitcoin, but you hopefully get what I mean there in that case. So that's the major thing to look for. Notice, again, how I always emphasize this, guys. I probably drive some of you guys nuts sometimes because you guys probably have your indicators you like. There's probably other ways that you look at charts as well. I didn't have to use any indicators, right? I'm just looking at basically what price is telling me. And that's the importance of naked trading, looking at support and resistance. And luckily you get to do it clothed. You don't have to be naked. Some of you would prefer to do it naked in this case, but it'd probably be bad if I did that on camera. Anyways, just wanted to go ahead and talk about that. In the sense of the weekly performance, which is really what I care about, this to me looks like a downward channel that I think eventually here into the halving event is going to likely get challenged to some degree, or eventually going to set ourselves up to get out of this channel, right? Again, just important to watch for here, guys. I think, again, as we've emphasized on the channel, these cycles are going to get longer and longer, right? So let me go ahead and get the logarithmic chart so this doesn't look crazy. There we go. The expanding cycles. Again, we talked about this in the newsletter. I want to make sure this is general public knowledge to you guys. I want to share it with you. If you look at the last 3 previous cycles, we've added anywhere from 11 to 13 months, give or take an average of 12 months a year to each of these cycles. So it's not a 4-year cycle. It's expanding cycles. And this makes sense. I've had this debate in my mind for a very long period of time because, many people sometimes argue, that, cycles could get smaller, right? And, as these halving events, have more and more of a dramatic effect, that's where people would make that argument. But really, it's the same effect time and time again. It's a halving and the reduction of Bitcoin supply. And the more important thing, I think, that it brings in the reasoning why these cycles are getting longer, even though the halving events are fixed in for 4 years, is because you're talking about markets of scale. It is much more difficult for an asset to go from, 100 billion, right, up to $1 trillion versus 1 billion to 10 billion, right? Those are both 10x's, but you're talking about much larger markets of scale that require much larger amounts of volume to get that price to where it needs to get. Right? It's inflows that we need in order to valuations to get where they are. And Bitcoin is not going to get up there unless you have retail investors, institutions, hedge funds, family funds, all these different sectors of the economy taking cash that they have and purchasing Bitcoin as a hedge or as an investment, a speculative investment, whatever you want to define it as. We can sit here and debate all day about what we think Bitcoin's going to be. The market will define what Bitcoin is, right? Bitcoin isn't changing anytime soon, So again, we'll see if the market does actually value it and push it up to these values in late 2022, up to 100K like we have predicted here, right? Could not maybe work that way. Who knows? It's no guarantee. The major thing I'm taking a look at here in the short term, though, Bitcoin's still way oversold, sitting here at about 15 points on the Scalpex index. And again, neutral is 50 points. So just back here in February, we were at 65 points up here when prices were around 10,000. So again, we've got a ways to go before I get really bearish on Bitcoin in the short term. And also along with that as well, we talked about altcoins here, Ethereum, holding on a very interesting line that has played as resistance and support in the past, right? Very, very important price level here where we had a double bottom here. And it looks like we might have a chance to break up to new relative highs here that we haven't seen since back in June of 2019. Very interesting price action compared to Bitcoin. Definitely keep an eye on ETH as you've got a lot of updates coming this year. All right, short-term talk here before we get into the big topic in regards to traditional markets. Most futures down about 1% here. Most markets are just generally trading right now and are down at the moment. But when we talk about U.S. markets right now, we have the S&P 500 Dow Jones down about 2%. The NASDAQ is the oddball at negative 1%. And this is because a lot of the tech companies are becoming more relevant than ever. Amazon right now playing a huge role in what's going on right now, getting even stronger in this environment. And along with that as well, a whole range of tech companies that are providing almost like a safe haven for investors during this time where people are basically isolated, quarantined at home, and especially not essentials. And a lot of businesses, again, are thriving and are probably going to continue to thrive even as people go back to work, because a lot of these people are probably going to work remote or from home in some capacity, so companies like Zoom, etc. This is why I think you're going to see a pretty stark divergence between the NASDAQ and the Dow Jones and the S&P 500. Very important thing to take in mind. All right. COVID-19 here. Good news here. Again, not going to talk about this too much. I want to talk about a much broader topic here. Good news is global cases seem to be flattening to some case, right? We haven't seen the stark decline yet, right? The good news here, though, is that this is during a period of time where testing is more available now than ever, right? It is ramping up like crazy. If you're in the United States, for example, right? If you want to get testing, you likely can get it. Look at the details here, guys. We've got the data. People are getting tests. If you're showing severe symptoms, there are places where you can actually go get tested right now, okay? So we're getting to that point here where testing en masse is getting out there into the open. You can see a lot of countries, the US here, for example, if you wanted to see the total case numbers, again, setting up its third relative peak here, looking like we're finally starting to flatten the curve. Along with that as well, Spain, again, getting a few spikes here. You're seeing this in a few countries, but again, it's kind of off and on here. And a lot of these days we have like no cases. So sometimes I think it's batching these cases and it's causing some discrepancies in the chart. Italy, very clean flattening of the curve here, starting to decline, showcasing social distancing is working. France here again, even though with these random spikes, again, we're still seeing a general curve here. Germany as well, another clear example similar to Italy, and the UK as well, starting to stagnate its growth here, right? This is really good to see, guys. Really nice to see. And I think that, again, if we come back prepared sometime here in the next few weeks when the economy reopens for most countries to some capacity with proper social distancing and day-to-day life as well, I would say the one thing I'd say, again, I'm not the leader of the world here, but I'd say if everyone made, for example, what I made and I showcased on Twitter, a cotton mask. It's where you take a Gildan cotton shirt. Everyone's got a 100% Gildan cotton shirt in their home, as well as some scissors or some rubber bands. There's two different ways you can make it. I made it a different way than what the CDC recommended because I made it before. But I'd recommend doing the CDC's way, where you can take a cotton shirt, you fold it up a certain way, get two rubber bands, and you can basically put it around your mouth. If everyone did this, if you, viewer at home, if you did this, fan of the Data Dash channel, part of the family, if you did this, and everyone around you did this, something that we can all do, it takes us less than a minute to 5 minutes, we could go about reopening the economy tomorrow. Because when I have a mask, even though it's not an N95, and when you have a mask, if I'm asymptomatic and I cough, this will suppress the vast majority of particles that might contain COVID-19. And along with that as well, your mask, even though it doesn't prevent everything, will do a great job of preventing that. And you combine that with social distancing, you would instantly see a stagnation in growth. A vaccine wouldn't be so urgent anymore. A year until a vaccine wouldn't be so deadly, right? This is the major thing that I would emphasize. But just wanted to share with you guys, there's some great tutorials online. If you look up the Masks for All movement, it'll talk to you about how to make the one I made. But I recommend making the CDC's one because you don't have to cut up your cotton t-shirt. And along with that, it basically turns it into multiple layers of cotton, whereas this is just basically 2 layers of cotton. So I recommend you guys do that. All right, so who's ready for a little bit of a rant and a rave here? If the mask thing didn't seem like a little bit of a rant and rave or opinionated piece, again, I think this is something that is something very close to heart for me, and I've tried to emphasize over the last few years because I love finance. You know, it's interesting to me. I love seeing financial markets. I love the human element of financial markets, but I've been stuck in a love-hate relationship with finance over the last few years. It's been complicated, guys, because quite frankly, I don't like the excessive financialization of the U.S. economy, of European markets, of most Western economies. This has been a big problem. You know, one thing that I think summarizes this very well is right now, for the first time in history, China, here in 2020, has outpaced the United States in research and development. And it is set to continue increasing that research and development, even as the U.S. is continuing to expand research and development on a total dollar basis. It's pretty expected. Not to mention, I think you'd probably have to account for inflation here, right? But major thing to keep in mind here is the pace and rate of innovation of the United States versus China, right? So I'm not here to bash on China per se, and I actually would say hats off to them for doing the research that they're doing. You know, at the end of the day, I can't judge them because it's exactly what I want to see for my country, right? But the major thing I want to talk about here is where money is going and why we are seeing a lack of real-world economic activity, when in reality, we are awash with cash, and we could be doing so many great things here at home in the United States, like China is set out to do over the next coming few years in 2025, right? So to summarize this, I want to bring up a point here from Marc Andreessen. Now, Andreessen Horowitz is one of the largest venture funds in Silicon Valley, and they invest in a lot of the major tech companies and major companies that you probably know about or use in your day-to-day life. Well, Andreessen came out with a recent piece. He does these kind of blog posts or these kind of articles that he writes out from time to time, and he basically wrote this during this time of COVID-19. And I think more than ever, we needed to hear this. And basically, again, he basically criticizes the current environment right now, that we need to get out there and really build. We really need to be at the forefront of technological advancements, not only in financial technology, not only in medical technology, as we've seen right now that you can't simply receive a payment or a loan when you need it. And along with that as well, people for a long time couldn't get tests that they needed. We weren't prepared at any capacity for COVID-19, right? And of course, things like this are always going to be a shock, but the sheer fact that we couldn't react within a week and a half with the proper amount of tests. I mean, this is very, very, painful. It has long-term ramifications, and it showcases us, on the long term, that we've lost our way when it comes to the real-world economy. What we opted in for the last few decades, really since in the 1980s, is the financialization of the United States and a variety of other economies, where we opted in to build financial markets rather than real-world markets. We decided to outsource shipping in order to save corporate earnings for a select few companies. And this is the problem that we've had, the dichotomy that we've had, where we've basically offset a lot of that research and development, that real-world economic activity, those good wages in this case that used to make us the backbone of the world in this case, that helped us thrive through a strong middle class and good wage protection for everyday people. What we did is we outsourced it. We excessively automated it and either shipped jobs overseas in this case. That's just basically what's happened. It's been a combination of those two. And now we're at a point here where we don't have those factories to be able to produce the things that we need, the N95 masks, to be able to produce the tests that we need. And also outside of that as well, again, as Andreessen talks about here, Mark really brings up a good point here in the sense of that, why aren't we, for example, a country awash in cash, why aren't we building factories like Tesla's built, right? The Gigafactory, right? Why don't we build hundreds of those across the country and become the manufacturing hub of the world? Why don't we build every incentive to bring those kind of jobs and that economic activity here and build the best quality products, build a new standard that the world hasn't seen yet? Because China hasn't done that, right? China can produce a lot of stuff, doesn't really produce quality products, right? Or at least you don't think of quality. Not to be judgmental in that case, but it's about mass production at the cheapest cost. Why don't we switch it to making it where we can automate when necessary to keep prices relatively low, but we build quality products and we provide sustainable jobs and real economic and growth and invest in real research and development. I completely say hats off to Andreessen for talking about this because most VCs don't give a damn about this. Most institutional investors have every incentive not to talk about this real world investment because at the end of the day, most money has been artificially propped up in equity markets over the last few years. People have only cared about taking companies to exit. They've only cared about propping up their stocks as that's really all they have an inclination to do. If they can take corporate money like they've done since the 1980s and increasingly inject it into stock buybacks like they've done every single year, they're going to do it. Well, for the first time, a lot of companies have committed during this time period not to invest in stock buybacks. In fact, since back here in mid-March, stock buybacks have remained at $81 billion. Whereas back here, for example, in 2017, we were well above $100 billion. Over here, for the last 2 years, in 2018 and 2019, we were at over $200 billion. The average year about that same rate, right? We're about half of where we were for stock buybacks, less than half. I would love to see this number remain flat, and I would like to never see this number increase again because there's no need for stock buybacks. Stock buybacks are a false positive in order to push prices higher. They set artificial demand where companies are taking the cash that, bear in mind, at the end of the day, yes, in this case, the shareholders can vote or the board of directors can vote in order to allocate this money. But at the end of the day, that is the cash that represents the company that employs thousands of people, that builds the products and services that you see on a day-to-day basis. If they don't use that cash in order to put it more into research and development, to pay wages for people, to hire people, and they put it in something like a stock buyback, the only thing that's going to benefit are the shareholders of the company who are looking for an exit as the prices keep soaring to new highs. And at the end of the day, when we hit these times where companies then become dry on cash, that means excessive layoffs, it means wage cuts, it means cuts to benefits, it means cuts to research and development, and it means cuts to real world investments in economic activity. You can either put money into an artificial market and say that the world's doing great, or you can put it into the real world economy and actually see it for yourself that real money into the real economy actually does real good, rather than putting it in some false artificial market that a select part of the population owns. And I say this as someone who has invested in stocks over the last decade. I know this all too well because I've seen the direct correlation of who's buying, and it's corporations, and how it's injected in not only through stock buybacks and dividends, through drip programs, and at the end of the day, how that props up equity markets and does little to support the underlying economy. So, anyways, again, there's a lot of arguments to be made, guys, but I'd like to hear what you guys have to say. I've rambled on enough for today. I hope you all enjoyed my rambling session. If you liked it, drop a like. I always appreciate it. But again, I want to say, Mark, I think, brought up a really good point here, and this is something that I've wanted to talk about. I've talked about it from time to time, but this is something that I really wanted to dive into for some time. And it's upsetting to see because, yes, there needs to be, I think right now, I don't think we have a better model compared to stocks. And then along with that as well, for example, Bitcoin, a lot of other assets, they don't yield or produce anything, right? But at the end of the day, right, even though there is room for those assets, I think companies' first priority should be to build, to innovate, and to provide great products and services for the future. And I sadly don't see the United States, as well as a lot of other countries across the world, doing that at the pace we used to. Not in an environment with the smallest number of small businesses being created. I think, what is it, the last few decades or something, we've been having a huge decline in small business and innovation in the United States. And that used to be the backbone of this country. So, anyways, hope you all are doing well wherever you are, guys. That's going to be it for the video today. If you liked it, like I mentioned, drop a like, leave a comment down below to contribute your thoughts to the conversation here in the Data Dash family, and I'll see you all in the next video. Stay tuned.